there are some investments, your car, that eat up all of your money, and then there are some investments, real estate, that put more money in your pocket. The reason why you invest your money is so you can be financially free and do the things that you want without having to worry about money. But all investments don't work the same. If you really never want to have to worry about money again, you need 3 different types of investments. You need an investment that's going to pay you with income, you need an investment that's going to give you growth of your wealth, and then you need an investment that's going to protect your money. So what I want to do today is go over the 3 investments that you need to make, that way you don't have to worry about money ever again, starting with number 1, which is investing in real estate for income. Traditionally, when people talk about making a passive investment for income, they talk about investing their money into the stock market, into a dividend paying company. So you look for a company like McDonald's that's been paying a good dividend, you invest your money into McDonald's, and then every quarter McDonald's is going to give you a dividend check. But I prefer real estate rental income, and I'm going to show you why. Real estate is the best place to generate passive cash flow. The way it works is you can go out and buy a property. This can be a house, this can be an apartment building, this can be a mixed use building. You go out and you buy this property, this building, and then you're going to lease it out to somebody else who's going to use your building. So in this case, we'll use a house, and now I'm going to lease it out to this nice person with a mustache, with his wife who has a braid, or as we like to call it in my native language, Punjabi, a gut. This nice couple live in my home. Now, in exchange for them living in my home and using my home, they're going to pay me $1,500 a month every single month for living in this property. I don't have to do any work after they move into the property because now I already own the asset. I'll give you another example of this. The minority mindset company's office right here is 2 floors, and I pay $4,300 a month to lease our office space. So this is money going to the landlord. I don't really see the landlord ever, but I give him a check every single month, and this is money that he uses to pay the mortgage for this building and put some money in his pocket every single month. The reason why I say real estate is the best place to generate this type of passive cash flow is because, for one, if you do it right, you're going to be able to rent it out to somebody else, and this rent that you get is going to cover your expenses, your taxes, your insurance, your maintenance, your management fees, and it's going to put some money in your pocket every single month. And if you do it right, you can hire a property management company to deal with all the day-to-day work. So if something goes wrong, if the electricity stops working in this office, I could just call up the property manager, and then the property manager will take care of the issue, and the landlord won't even hear about it. So I like real estate because of the cash flow that you can get, and it can be pretty passive. I'll explain why I say pretty passive in just a second, but the second reason why I like real estate is because of the tax breaks that you get as a real estate investor. Now, although I am a licensed attorney, I'm not your attorney, so if you have specific tax questions, talk to a tax professional in your area. But the IRS rulebook gives real estate investors some of the biggest and best tax breaks that our tax code has to offer. I'll show you what I mean. So if I can rent out this home for $1,500 a month, and let's assume for the sake of this example that my expenses are $1,000 a month to own this property. That's my taxes, my insurance, my maintenance fees, my management fees, and my mortgage is $1,000 a month. This means that every single month I get to put $500 worth of profit into my pocket. This is the money that I get to put in my pocket, which means every year I'm putting $6,000 into my pocket. Now, generally, when you make $6,000, you have to pay taxes on $6,000. But because this is real estate, you get a little bit of a tax break. You get to tell the IRS, hey, I made $6,000. This is the money that I put into my pocket. But because my property is 1 year older, I deserve a tax break. So going back to this home, let's assume that when you bought this home, it was $20,000 for the land and $150,000 for the actual house. Now, you will get to tell the IRS that because this property that I bought is 1 year older, I deserve a $5,500 tax break, which means you put $6,000 in your pocket. This is the money that's in your bank account, but you only have to pay taxes on $500. This is your taxable income because you get to take this depreciation expense on your property. You calculate this depreciation number based off of how much you paid for the property, but this is a paper depreciation. It's a paper deduction, meaning you take $6,000, put it into your pocket, you can spend all this money, but you only have to pay taxes on $500. This reduces your taxable income and your tax rate because your income is less. This is the first reason why wealthy people love investing their money money in real estate because you can make a ton of money and pay next to nothing in taxes legally because the tax code says so. And the second reason why wealthy people love investing in real estate for the tax breaks is because, well, let me just show you. So you bought this home for $170,000. You paid $150,000 for the building and $20,000 for the land, a total cost of $170,000. Now let's assume that you own this property for a number of years. Every single year you rent it out, and every couple of years you raise the rents, meaning you make bigger profits. And then some time goes by and you look at Zillow and you see, oh, I could sell my property for now $1.7 million. Now, this does happen in some instances. Most of the time, you're not going to see this type of exponential growth in just a few years. But if you're invested in a good area where you see growing demand, where people want to be, you're going to see the prices of your real estate go up. So assuming that this property value goes up from $170,000 to $1.7 million, and now you sell it, well, now you have a almost $1.5 million gain, which means you got to pay taxes on $1.5 million. Now, even if you have a low tax rate, because investors get lower tax rates, that's still a lot of money. But real estate gives you another exception, because now what you can do is you can take all of this money, you take the $1.7 million and you go out and you buy a bigger property. Let's assume that now you buy a bigger property with multiple units. I clearly am not a good artist here, but you go out and buy a bigger property with this $1.7 million, and this $1.7 million property is going to pay you with more rent, more profit because it's a bigger property, and bigger tax breaks for your depreciation deduction. But now the advantage not only is that you own a bigger property, but you don't have to pay any money in taxes today. This is called a 1031 exchange. It's called a like-kind exchange. You don't get this in the stock market, but you get this in real estate, where you can flip your property after 1 year. You own the property for a year, you can sell it for a profit, flip it into a bigger property, and pay $0 in taxes today. And you can do this again and again and again, keep flipping properties into a bigger and bigger and bigger deal. And you can do this until you die and never have to pay a penny in taxes on these capital gains. This is what wealthy people love doing with their real estate, because you can just keep flipping into a bigger property every year or every couple of years, whenever you're ready. You can just keep flipping the property into something bigger, and you never have to pay taxes on those gains as long as you do this 1031 like-kind exchange. Now again, make sure you talk to a professional, an attorney, a tax professional in your area, that way you're doing this the right way, because there's a lot of regulations that are involved with 1031, but this is one of the biggest loopholes for wealthy people, because now once the numbers start to get bigger, you just keep adding on zeros and you keep going into the bigger deals and the bigger deals, and now your rental income goes up, which means you have more cash flow to live off of. The key here, for one, is this requires you to buy real estate not for you to live in yourself, but for you to rent out to somebody else, because now this becomes an investment that you're buying for the sole purpose of making money. And second, you have to understand your market and you have to understand the type of real estate that you want to buy. I like residential real estate because this is a innovation-proof real estate. We're always going to need a roof over our heads, no matter how crazy the metaverse becomes, which is why I like residential real estate. We've seen retail real estate get hit so hard because of the digital revolution. We've seen office real estate get hard because of the pandemic and people working from home. Those two will keep going through innovative shifts, and they're going to be changing a lot. But residential real estate, we know that people will need a roof over their heads, which is why I like single family homes, which is why I like apartment complexes. The last thing that I want to say regarding real estate is what determines a property that I want to buy, because a couple things that I look for beyond just a good area, low crime, growth in population, young people wanting to live there. Once I have all that, the other thing that I want to look for is the numbers. And when I say the numbers, a lot of times people get confused when they look at real estate, because they say, oh, I can buy this property for $150,000 today, and maybe in a few years I'll be able to sell it for $300,000. And if they think like that, they'll be willing to overpay for the property because they have their eyes set on the future price appreciation. All they're looking at is how much can I sell this property for in the future. I don't do that. When I buy real estate, I don't care about what's going to happen to property values tomorrow or next month or next year. The only thing that I care about is how much cash flow I'm going to get. So remember, my goal with real estate is cash flow. I'm working to create income. So when I invest in real estate, I don't care about what's going on with property values. What I'm looking for is a 7% cash on cash return on my money. Meaning, for every dollar that I invest, I'm going to make 7 cents in positive cash flow, 7 cents in profit every single year. If I invest $100,000, That's $7,000 a year in positive cash flow. That's what I'm looking for. So when I invest in real estate, remember, you have to understand your goal. My goal is cash flow. Property values crash, okay, I'll go out and buy more. I don't care because this is what I'm looking for. I don't really care about that growth. This is what I'm investing for. And if I do see a lot of growth in real estate prices, well, that's icing on the cake. The second place where you want to be investing so you don't have to worry about money is in businesses. Now, the reason why I say in businesses is because this goal is to give you growth. With real estate, it was cash flow. Here, when I invest in businesses, I'm looking for growth. And the reason why I say growth in businesses is because you have to look at how do you attract money. The more value that you can provide, the more money that you're gonna make. Well, when you go out and you buy a home or you buy an apartment complex, the only way that you can really add more value to raise rents is if you renovate the units and if you make the home nicer. But at the end of the day, if the location isn't good, you're not going to be able to raise rents significantly. So you're ultimately dependent on the location, which is why real estate is more of a passive way for you to generate that type of cash flow versus in business, you can invest in companies that are working to produce more value. You can invest into a company that way they can use your cash to hire more employees, to innovate, to create new products, to sell more products, because now the business is actively working to create more value and produce more revenue and make a bigger profit. Now there's a number of different ways that you can invest in business depending on your risk tolerance. So I'm gonna do it in order of least risky to most risky. The least risky would be investing in the stock market. Now you're investing in established companies. Many times these are companies that are worth billions of dollars. Now, of course, you can see a stock go bankrupt, you can see a stock go to zero, but a stock that is on the stock market is less likely to go to zero than a startup that has less than $100 worth of sales. The second, which is a little bit riskier than the stock market, would be investing into what I just said, a startup. A startup now is maybe you're investing into a smaller company, a company that's working on raising their first million or 10 million or $100 million. You could invest some money into the startup, give them some money, that way they have some cash to go out and grow and hopefully get bought out, hopefully go public. That way you can then liquidate your equity and make some more money. This is what you see happen on Shark Tank, where the sharks, the investors, are investing into startup companies and they're hoping to see the startup companies grow. And then you have the option of investing in your own business. Now, I was really debating whether to put this here or this here because when you invest in your own business, you're investing in yourself. And at the end of the day, you are your best investment, which is one of the reasons why it might not be as risky of an investment. But the reason why I put it here is because not everybody's meant to be an entrepreneur. And you don't always know that until you go out and try to start your own business, because starting your own business is tough. You have to be very disciplined. You have to be very creative. You have to be able to do the things that a leader and an entrepreneur does, which isn't always very intuitive. So that's why I put it here. But another way that you can invest in business is just investing in yourself and creating your own business. The reason why this is so important is because when you invest in businesses, you get equity. Equity meaning ownership, because that is the way that you build wealth in our economic system. Equity is so important because it allows you to monetize on perceived value instead of just the value that you created. So if you go to work every single day and you make $50,000 a year, you only get $50,000 worth of value. You're only getting $50,000. But if you're a company and you make $50,000 worth of profit, your company might be worth $500,000, 10 times the profit. Because now the equity, the value of the company is worth a multiple of that profit. So a way for you now to capitalize on this perceived value, this equity game, is by owning a piece of these companies. Now obviously you can invest in your own company where you work at, or you can go to the stock market and invest in some of these companies. This whole multiple valuation game is so powerful because it allows you to capitalize on this perceived value and allows you to capitalize on the growing values of companies that you believe in. I made a video talking about this not too long ago, but we live in a capitalist society. And in a capitalist society, you can make money one of two ways. You can make money from your labor, which is you going to work every single day, or you can make money from your capital. Make money from your capital is when you invest in equity. It says it in the name. In a capitalist society, the way that wealthy people make their money is through their capital more than from their labor. So what you want to do if you're working to become wealthy is you need to use your labor as leverage to use that money that you earn to now go out and invest in equity. That way you can put your capital to work. So you get your capital from your labor. Now you need to put your capital to work by owning equity in the right companies. That way you can get the growth of all the smart people working hard to grow your companies. And there's 3 ways that you can do that. You can invest in publicly traded stocks, you can invest in startups, or you can invest in your own business. Publicly traded stocks means a company is now on the stock market and anybody can go and buy and sell shares of this company. So if you go and buy 1 share of Amazon, you become one of the owners of Amazon. If you buy 1 share of McDonald's, you become one of the owners of McDonald's. Now you don't get to tell the company what to do with that small of ownership, but you get to share in the profits, because as these companies make more money and their profits grow, well, the share price goes up. If they don't make as much money and their profits shrink and their companies go bust, well, then the share price of the company that you own will go down as well. So there is risk associated with it. You're never guaranteed to make money, but if you invest in the right companies, then you can make more money. Now, the way that you invest is going to depend on you. If you like the idea of studying companies and researching companies and reading their financials, then you can go out and invest in individual companies. I like doing that. But if you're not interested in doing all the research and putting in all that time, then you can just invest in some ETFs, an exchange traded fund, which gives you exposure to a basket, a group of companies. I do this as well. So I have a passive strategy where every week I have money that's automatically being invested into a few different ETFs. One ETF is giving me exposure to the S&P 500, which is the biggest 500 companies on the stock market. Some ETFs, they give me exposure to innovation. These are companies that are more along the lines of your technological startup companies that are trying to innovate and create new products. And then I have some ETFs that give me exposure to emerging markets. These are companies and countries that are overseas that are working to grow there to give me some protection in these ETFs. So in my passive ETF investing system, all I'm trying to do is just invest my money into these ETFs, which give me broader exposure to a bunch of companies instead of me perfectly trying to pick the right company. And then in my active strategy, I'm looking for the right company. When I find a good price, that's when I'll come in and buy. That way I can build my equity. But the whole goal here is for me to just accumulate more and more equity over time by consistently putting in more money. With startups, it's a little bit different. Now you're investing in smaller companies that are trying to grow, that are trying to get some sort of market share. That way they could go on to the next stage of their business. The risk here is when you're that small, there's a bigger chance that you will fail. But if you hit the right one, now you can see an insane return on your money, because if you can find the next Amazon or the next Uber before it becomes Amazon or Uber, well, now you can see a massive return on your money. So higher risk and higher potential reward. Now there's a bunch of platforms on the internet that let you do this. WeFunder, Republic, and Start Engine are just a few. I've invested some of my own money onto companies on WeFunder. They're not sponsoring me. They're not paying me to say this. I'm just telling you some things that I've done. So I've invested some of my own money into a couple companies on WeFunder. I've invested into a company called UpCouncil and a couple others. So I like this type of startup investing because I like entrepreneurship and I like taking on some of this risk and I like seeing these companies grow. But you got to know you. If you don't like that added risk, then maybe this isn't for you. And then you have the option to invest in your own business. So earlier this year in 2022, I separated Minority Mindset from the companies and products that we had under Minority Mindset, one of which is Market Briefs. MarketBriefs.com is now its own company, and this is our daily financial newsletter. We were running this through Minority Mindset, but the problem was I was having a hard time separating myself, Jaspreet Singh, from Minority Mindset, from the products and companies inside of Minority Mindset. That's when I realized that Jaspreet Singh is Minority Mindset, and then I separated the companies like Market Briefs from Minority Mindset. So now Market Briefs is its own company, and I'm investing my own money that I make from Minority Mindset and other places into Market Briefs. That way I can grow Market Briefs and our team bigger, faster, because I believe and I know that our Market Briefs newsletter is the best financial newsletter out there, and I'm working to grow this every single day along with our whole Market Briefs team. But before you go out and just blindly throw your money into your business, you have to first understand the risks and the work that it takes to become an entrepreneur. I know there's been this whole movement of working just a few hours a week with a laptop lifestyle if you're an entrepreneur. It doesn't really work like that. Entrepreneurship is hard. You're going to work a lot of hours. You're going to have to make a lot of sacrifices, and you're going to have to put in a lot of time. And if you're not willing to do that, then I do not recommend you go out and start your own business. Now, going back to the goal here by investing in these types of companies is so you can see more growth in the companies that you're investing in. You want to invest $1,000, that way you can see your $1,000 grow to something a whole lot bigger. Then you can take this new money that you have and you can either live off of this money, or you can take this money, put it into real estate and create more income off of this growth that you created from your stocks. That's the way that I look at this. I don't really like investing in stocks for dividends, especially right now, because if a company is paying out a dividend, what that means is that this company is taking out their profits and they don't have a better place to use this money. They're not going to use this money to go out and buy another company. They don't have a place to take this money and invest it back into their company to grow faster because they're already pretty large. So instead, they take their big profits and they just give it away to shareholders. Now, it's good for shareholders because you get regular checks in the mail, but then that also means that you're going to see slower growth because this company has a bunch of money and they don't have anywhere to put it. So if that's something you're interested in, then you can consider investing in dividend-paying companies, but I rather see my cash flow through real estate, which is why I like real estate income, real estate cash flow more than I like dividend cash flow, and I like the idea of investing in businesses. That way I can see the growth through building more equity in these companies. Third, you want to invest some of your money into real money. And the reason why I say real money is because you want to have a protectionary investment. That way, if the American dollar begins to collapse, if the American economy really starts to go down and real estate prices now aren't worth as much and businesses aren't worth as much, you want to have something to fall back on. This is why I own some physical gold. Gold is your traditional inflationary hedge because gold has been used as real money for centuries, and everybody, whether you're in India, China, Mexico, United States, everybody knows the value of physical gold. So I own some physical gold for that reason. And the new thing that you're seeing a lot of young people move towards is Bitcoin. Now, I own Bitcoin as well, and I buy Bitcoin on a daily dollar cost average system, but Bitcoin doesn't provide you the same security that gold does. Sure, Bitcoin might be the next digital gold. Bitcoin has a lot of potential in the future, but it is not exactly there yet. It's not there yet in the sense of protection. It's not there yet in the sense of security. However, it might be there in the future, but because Bitcoin is just so volatile, you see so many crashes and swings up and down, I wouldn't say that it is your real money the way that gold is. Now, I believe in Bitcoin. I think there's a lot of potential behind Bitcoin, which is why I buy Bitcoin every single day, but I also own physical gold as another way for me to save money. I look at gold like real money. I don't really care about what's going on with the price of gold. I just look at it as a way for me to save some hard money because I understand that physical gold is real money, and if the worst were to happen and I need to pick up and go somewhere else in the world, well, I could take my gold with me and I know that I could convert my gold for another sort of currency or money or whatever I needed to do. So this is my protectionary. I know that gold will provide me with that. Bitcoin will hopefully do the same thing, which is why I'm buying Bitcoin. But this is, if the world starts to end, doomsday scenario, this is my protectionary investment for that. And Bitcoin is kind of that, but it also is a way for me to invest in the new age technology. It's a way for me to invest in the blockchain because I think there's a lot of value in Bitcoin. But again, very volatile, very speculative. We're going to jump back into the show in just a minute, but before we do, here are a few words from our sponsor, M1. If you've been watching my videos, you've probably heard of me talk about passively investing your money in the stock market, where you have a CPA, a consistent, passive, and automatic system where money is automatically invested into the stock market for you. Well, a super easy to use platform that can help you passively invest your money into the stock market is M1. And as a little disclaimer, at the time of me recording this video, M1 is a tool that I use to passively invest my money into my portfolio of ETFs. The way it works is you get to create your pie or your portfolio of ETFs or stocks that you want to invest in, and then you can create a cadence of how often you want to invest into this portfolio of ETFs or stocks. For me, I invest every Wednesday. You can invest every 2 weeks, every month, but once you pick the cadence, you set it and forget it. Now, of course, investing has risks. Are you guaranteed to make money when you invest? No, of course not. In fact, you will probably lose money at some point, which is why you want to always do your own due diligence and never blindly trust a random guy on YouTube. But you can mitigate some of your risk by investing your money into
good assets for the long term, which is why I invest my money into my portfolio of ETFs, whether the market's up and down, because I'm investing for the long term. Now, of course, you want to do your own research, get a financial advisor if you need one, but M1 is a great tool that can allow you to passively invest your money yourself. Minority Mindset is a paid partner with M1, meaning if you use them, we will get compensated, but there's no additional cost to you. So if you want to learn more, I got the link to how you can do that down in the description below, where you can go to theminoritymindset.com/M1. That's theminoritymindset.com/M and the number 1. And with that, let's go back to the show.
Mutual funds, index funds, and ETFs are 3 ways that you can invest your money in the stock market, but they can come with very different investment results. When I invest my money, there's 2 things that I always look for. I look at how much risk is involved, and I look at how much money I can potentially make. If I was going to invest $10,000 and I had to decide between investing this $10,000 into my broke cousin Bunty, who's on his 34th business idea, or investing this money into Amazon, who's established and has a business plan and is very successful, I'm going to expect very different returns to justify my investment. Bunty is a risky investment, so I'm going to need bigger potential returns to justify me giving him my cash, because as soon as I give him that $10,000, there's a good chance that he's going to invest that money into a new Gucci wardrobe. I gotta look good for the business. Deciding between investing your money in my cousin Bunty or Amazon is pretty obvious. I'm gonna invest my money in Bunty. But what if you had to decide between investing your money between Amazon and Apple and FedEx and Verizon and McDonald's and Microsoft? Who's gonna give you the best return for your risk now? Not so easy anymore. There's 3 different ways that you can take this. Option 1 is you can spend all the time researching these companies, and you might decide that Apple is the best company to invest in based off of all your research, and now you invest all your money into Apple. This one has the most risk, because now if Apple releases a really bad iPhone and people start hating Apple products and their company tanks, well, down with it goes your money. It also comes with the most upside, because now if you're right and Amazon wins big, then you're gonna win big. Option 2 is now you can open up a stock brokerage, and instead of just investing in one company like Apple, you can invest in every one of these companies. That way you're lowering your risk. This one requires more work, because now you're not just managing and monitoring one stock, you gotta manage and monitor a whole portfolio of your stocks. Or option 3 is you can pay a small fee, and then you can invest in a fund like a mutual fund or an index fund or an ETF, and let these funds invest in all these companies for you. So now instead of you going out and investing in all these companies, you invest in a fund that gives you exposure to all these companies. Well, all 3 of these funds give you exposure to the stock market. They work in very different ways, which can affect how much money you make, which is why you want to understand the differences. And that's what I'm going to be going over in this video as soon as you fund that thumbs up button below. Let's start with mutual funds. Mutual funds are known as actively managed funds. And to understand how they work, let's assume for the sake of this example that this is a mutual fund that's made up of only 4 stocks. A lot of times mutual funds will have way more stocks, sometimes hundreds of stocks, but just to keep things simple, we're going to assume that this mutual fund only has 4 stocks. If you wanted to invest in McDonald's, Tesla, Apple, and Amazon, one thing that you could do is you could go out, open a stock brokerage, and individually invest in McDonald's, Tesla, Apple, and Amazon. But now you have to decide how much of your money are you going to allocate towards each stock, and what stocks do you want to own. On the flip side, when you invest in a mutual fund, you have this person right here. We're going to call this person a money manager, and we're going to draw him a nice mustache. This money manager is who you're trusting. So you're going to give your money to this money manager, and this money manager is going to create this fund. So this person is managing this fund, and when this money manager likes a stock, they're going to buy it. When they don't like a stock, they will sell it. So maybe right now this money manager likes these 4 stocks, but some time goes by and he's like, you know what? I don't like McDonald's anymore. We're going to replace them with Chipotle. So now he's monitoring the stocks, and he's actively buying and selling based off of what he thinks is going on in the market and based off of what he thinks is going to make this fund more money. The whole point of a mutual fund is to have a really smart money manager, with the goal of this money manager being able to beat the general stock market. So you were hoping that by paying this money manager a fee, you were going to be able to outperform the stock market, which in turn will make you more money. You're also getting the benefit of passiveness, because now you're not having to go out and individually invest in all of these companies and manage each one of these companies. You have a money manager who's going to do that, and you also have the benefit of diversity, because now this money manager is diversifying your money into different companies. If you want to invest your money into a mutual fund like this, you can expect this to cost you something like 2% a year on all of your assets, What that means is if you deposit $100 into your mutual fund, this money manager is going to take $2 a year to manage your $100. So if you invest $1,000, that's $20 in fees. And if you invest $100,000, that's $2,000 a year in fees. Now, while 2% might not sound like a lot of money, it does add up, especially as your money grows and compounds. Like if you started investing $500 a month today and you were paying 2% a year in fees, and you were able to get an average 7% return on your money, over the next 30 years, you're going to end up paying something like $166,000 in fees to your money manager just to invest your money. Now, look, I'm a value person. If you can make me an extra $1,000, I will gladly pay you an extra 2% in fees. So if you can make me more money, I will pay you more money as long as I continue to come on top. The only issue with this is what we've seen over the long term is these mutual funds don't always outperform the market. Actually, a lot of mutual funds can't even meet the returns of the general stock market over the long term. Like Warren Buffett was so confident in this that he made a $1 million bet that the general stock market, the S&P 500, would be able to outperform a number of hedge funds. These are highly sophisticated, highly expensive hedge funds. And over a course of 10 years, the hedge funds did well, but they did not even meet the stock market returns. So then the hedge fund owner had to then pay Warren Buffett $1 million because he lost the bet, and Warren Buffett took that $1 million and he donated it to charity. I'm going to go over how you can get the general returns of the stock market without paying these high fees, but in general, a mutual fund's goal is to be able to beat the market. That's why you're paying these fees to a money manager. That way you have somebody who can hopefully beat the market. The only problem with that is a lot of times you will not beat the market. Sometimes you will, sometimes you won't. It's really hard to predict because it's hard to beat the market, especially over the long term. This is not to say that mutual funds are never the right answer. I mean, there are some really good mutual funds out there, but a lot of these really good mutual funds are reserved for super high net worth people. Like you need at least $500,000 to get into some of these mutual funds versus some of the regular mutual funds that you're just paying 2% on. You could get a better return without paying all the fees. Second, let's talk about index funds. So the whole idea of index funds came about by this company called Vanguard. And Vanguard said, you know, what if we could let people invest in a group of funds like this without paying these super high fees? Well, the only issue with that is you need to pay this money to a money manager. So if Vanguard wanted to create this index fund where you can invest in a fund without paying all these fees, they also had to get rid of this person with a mustache right here. And instead what they did was they replaced that person with a mustache with a computer who automates this investments. Now you're investing in a fund, a group of companies, but instead of having a money manager decide which companies are in this fund, you're going to have a computer decide. So you create an algorithm. What are the type of companies you want to invest in? You punch that into the computer, and then the computer decides what company fits that fund. For example, I just talked about investing in a fund that gives you exposure to the S&P 500. The S&P 500 is an index, meaning it's a group of stocks that gives you exposure to the top 500 companies in the stock market. Now, one thing you can do is go out and individually invest in all 500 of these companies, but that's going to take a lot of work and a lot of management headache. Or you can invest in an index fund that gives you exposure to all 500 of these companies. That's what Vanguard allowed you to do. Now you can just invest in this index fund, and that gives you exposure to these top 500 companies. So now you're getting exposure to the general stock market without paying all the fees. VFIAX is the Vanguard index fund that gives you exposure to the general stock market. So Vanguard is the company that created this index fund. There's a bunch of banks and a bunch of companies that create these type of things. Vanguard is just one of those companies. It was the first to create index fund. So Vanguard has this index fund, which is a group of stocks that gives you exposure to the top 500 companies. If you want to know how much fees these index funds cost, all you got to do is search it on Google. So like with this VFIAX, you can see it says in the title that this is the Vanguard 500 Index Fund Admiral Shares. It has the word index fund in the title, so you know it's an index fund. And over here, you can see something called the expense ratio. This expense ratio is how much money you're going to be paying in fees. That's what you want to pay attention to. 0.04% in fees means that for every $100 you invest, you're going to be paying 4 pennies in fees. Compare that to the 2% fee you'd have to pay with a mutual fund where you're paying $2 out of every $100 you invest. So the fees with an index fund are way less because now you substituted that money manager with a computer, and computers are a lot cheaper to maintain than people, especially if they have a mustache. What you have to understand about index funds is a lot of them have a minimum investment. Like this Vanguard index fund has a minimum investment of $3,000. So if you don't have $3,000 to invest, you cannot invest in this index fund, and you also can't just buy and sell this index fund whenever you like. Index funds like VFIAX only let you buy and sell this index once a day. So if you're trying to trade index funds and mutual funds, that's not the way to go, because you can't just buy and sell an index fund whenever you want. You can only do that one time in the day, and typically it happens at 4 p.m. as soon as the market closes. But if you're looking to be a long-term investor, it really shouldn't matter too much, because now you're looking to invest for the long term. You're not looking to invest for 2 hours. And so what happens now is you're not going to see people trading these index funds every single day, because you just can't do that. The alternative to investing in an index fund like this is investing into an ETF, which stands for an exchange traded fund, because ETFs that you buy and sell these funds kind of like stocks. You can buy and sell these ETFs whenever you want, and some index funds have ETF versions of them too. Like if we go back to the Vanguard website, you'll see that this index fund also has an ETF version. It says it right below the title. Also available in an ETF. If you click that button, it will take you to the ETF version of this index fund, which is VOO. VOO is an ETF that gives you exposure to the S&P 500, so the top 500 companies in the stock market, and this has an expense ratio of 0.03%. You can find this the same way you find the expense ratio of an index fund. Just search it on Google, and on this website, it will tell you what its expense ratio is. That's how much money you have to pay in fees every single year. So here, if you invest $100, you're going to be paying 3 cents a year in fees, so almost nothing. But unlike an index fund, you can buy and sell shares of VOO every single day whenever you want when the market is open. Remember, with the Vanguard Index Fund, you had a $3,000 minimum investment, and those transactions only happen once a day. With VOO, you don't have a minimum investment. All you have to do is buy one share of this ticker symbol, and then you can buy or sell VOO whenever you want throughout the day. So between this Vanguard ETF that gives you exposure to the S&P 500 and the Vanguard Index Fund that gives you exposure to the S&P 500, they both charge you essentially the same fees. They both invest in the same companies. The difference is VOO, you can see the real-time price throughout the day, versus the index fund you cannot. VOO does not have a minimum amount of money you have to invest, versus the index fund you do. However, the index fund allows you to automatically invest or withdraw your money, versus this ETF does not. So if you invest your money through Vanguard, you can automatically reinvest more money every single month through Vanguard, versus with this ETF, you cannot do that. So if you're looking for a passive way to invest your money, the index fund gives you the benefit, because now your money can automatically be invested every single month without you having to do anything, versus you can't do that with an ETF unless you're using a brokerage that can passively invest your money for you. The whole reason for you to invest your money into these passive investments is to see your money passively grow and compound over time. But if you want to see your money really compound quickly, you got to keep adding money to your investments. And the simplest way to do that is every single month, just add more money into this fund. So if you invest your money into the index fund, that can automatically happen. You can't do that with this unless you use a brokerage that automatically pulls money out of your savings account or your checking account, and they invest this money into your fund. If you want to learn more about how to do that, our team put together an article that breaks down the basics of investing, and I'll link it for you in the description below. So ETFs work almost the exact same way that stocks do, because you can buy or sell shares of an ETF the same way you do a stock. You can see the real-time price of an ETF the same way you can do a stock, and you don't have a minimum investment you have to invest minus the share price the same way you do a stock. Index funds, on the other hand, can give you exposure to all the same companies, and they let you do the automatic investing too. When it comes to your money actually being invested in an ETF or an index fund, there's an algorithm that tells the computer which company should be in your fund. So if you're investing in this ETF or in this index fund that gives you exposure to the top 500 companies, now what this algorithm is going to look at is which companies are in the S&P 500. If one of the companies in here, so let's assume Tesla for the sake of this example, tanks, and Tesla stops making money and their market cap decreases, then what this index fund will do is say, okay, Tesla is no longer in the S&P 500. They're no longer one of the top 500 companies or the biggest 500 companies. So they're going to kick Tesla out, and they're going to put in whatever the new company is that replaces Tesla. So it happens passively. You don't have to do anything. This happens in your index fund for you. And because this is happening through an algorithm, through a computer, you get to pay way less fees. So between mutual funds, index funds, and ETFs, which one can make you the most money? Well, before I say that, let me just remind you that investing has risks. You are never guaranteed to make money when you invest. You might even lose money. So make sure you always do your own due diligence and never blindly listen to a random guy on YouTube. In general, for the majority of people, there's always going to be outliers and exceptions to the rule, but for the majority of people in general, index funds and ETFs are going to be the better way to go, because now you're going to meet the stock market returns and you don't have to pay the super high fees. Now, obviously, there are some mutual funds that are gonna do great. There are some mutual funds that are gonna greatly outperform the market, but there's a chance that you might not get that mutual fund. There's a chance you're going to pay the high mutual fund fees without even getting the market returns. So if you believe in the American economy, then you're going to believe in the American stock market, which means over the long run, the stock market will continue to go up. And if that's the case, then you can just get the consistent returns of the stock market by investing your money in the general stock market, by investing in an ETF or an index fund that gives you exposure to the general stock market. Between an ETF and an index fund, this is really personal preference. I mean, do you want to have the automatic reinvestment into an index fund, or do you want to just invest your money into a brokerage that can automatically invest your money for you? Personally, I like ETFs because I like the freedom that comes with them. The key to succeeding with any of these is really just consistently investing your money month after month after month and keeping your money in the market for long enough. History has showed us that the stock market and the economy always goes up. That doesn't mean it'll always go straight up. Sometimes it will come down, sometimes it will crash, and sometimes it will correct. But over the long run, it will continue to go up as long as the economy keeps growing. So if you believe in the American economy, then this is a way for you to get that upside without actually starting your own company.
We're going to jump back into the show in just a minute, but first, here's an advertisement from our sponsor, me, with Briefs Media. If you're looking for an easy way to stay up to date on what's happening in the top finance and business news, we make it super easy for you to do that at Briefs Media because we created a free newsletter called Market Briefs. Market Briefs is a super simple and easy way for you to stay up to date on the top finance and business news. You can read Market Briefs in less than 5 minutes every morning. It's a fun and witty and easy to read newsletter, and I promise, if you join Market Briefs, you are going to love it. Now you might say, Jaspreet, how can you promise that I'm going to love Market Briefs? Well, if you don't love Market Briefs, you can unsubscribe at any time because it's completely free. So if you have not joined Market Briefs yet and you want to stay up to date on what's happening in the top finance and business news, I got the link to how you can join Market Briefs down in the description below, or you can go to briefs.co/market. That's briefs.co/market. And with that, let's go back to the show.
There are 5 keys to being a successful real estate investor. Number 1, you need to know how to find a good location. Number 2, you need to know how to build a good team. Number 3, you need to know how to run the numbers. Number 4, you need to know how to do the due diligence on the property. And number 5, you need to know how to increase the value of your investment. These are things that I learned over the last 12 years of investing in real estate, making a lot of expensive mistakes and seeing some success. So let me start by talking about number 1, which is understanding the location. The 4 factors that you want to be paying attention to when you're looking at a good location is the crime in the area, the population and population growth, businesses moving in or out, and the walkability of the area, especially if you're looking at a city, a more urban environment where people can actually walk around places as opposed to a suburban environment where people have to drive places. So let me start by talking about crime. I mean, the general consensus is people want to be in a safe place. And so you can go do a Google search to see the crime in your neighborhood, see the crime in the city, see the crime in the county, and see the crime in the general area. And if you see crime increasing, that's a bad sign. If you see crime decreasing, that's generally a good sign because tenants want to feel that they're safe in your home. But you want to take this factor with a grain of salt because Manhattan has a lot of crime, but people want to live in Manhattan. California has crime. People want to live in California. Just because it's crime doesn't mean it's not a good place to invest. It's something that you want to be paying attention to if crime is rising or if crime is going down. And you're not always going to get a good answer by just searching crime scores and doing crime maps on the internet. This is where you got to get the feel of a neighborhood where you're investing because real estate is very localized. And you don't want to just throw your money into an area because you think of something good that you found on Google. You want to actually drive the neighborhood, walk the neighborhood, stay there for a little while, and get the feel. You're not going to be able to get that real feel of the area without actually spending some time there. And if you want to actually be a real estate investor, you need to spend time in the areas that you are investing. If you don't live there, fine. Drive through it. Walk through it. Do you feel safe walking through it? And is it somewhere where you wouldn't mind spending some time? Second, on the population side, do a quick Google search of the city and neighborhood that you're looking to invest in and see the population. So go to Google, search Manhattan population. And what this will show you is the population and the population trend for Manhattan. And you can do this for different neighborhoods, different cities around the country. And what you want to see, ideally, is populations rising or at least populations staying stable. But you don't want to see populations dropping because if populations are dropping, that means that the amount of tenants in the area are probably also dropping. And you want to be investing in an area where more people are moving to, because if there's more demand for your property in the future than there is now, that means that rent prices will probably have to go up because more people want to live in the area that you own that real estate. Third, you want to be investing where businesses are moving to. So this is a little while ago now, but I remember I was looking at some real estate in a city that's near me, and there was a city block that was completely vacant, and it had some big real estate that was all vacant, and it didn't look good. And I asked the city about what was happening here, and what they said is that a Walmart had just entered into contract to purchase all this land, to purchase the building, and they were planning on opening a Walmart supercenter. When I heard that, I started buying up some of the real estate near this area, and over the next few years, not only did Walmart open up a supercenter here, but then you had all these other new retail stores that opened up around the Walmart because Walmart brings a lot of traffic. People want to go to Walmart. And so that opened up all these other new retail shops, and then new real estate developments opened up on the other side of the street, which was also vacant, and this drove a whole new set of traffic and businesses into this area, which meant more people wanted to be here, more people wanted to shop here, and more people wanted to live here, which not only increases the value of the real estate, but it also increases the rental prices of the real estate. Now, how do you find where businesses are moving to? Now, you can look at the press, you can look at the news, but many times if it's already hitting the news, it might be a little bit too late. And this is where real estate is special, because this type of insider trading, insider investing is not illegal in real estate. In fact, it's completely legal. So how do you get this information? Well, one of the best places to go is actually the city hall. Just go to the city hall, the building department, and ask them if there are new businesses coming into a particular area. Is there some new developments coming? What's new happening in this city, in this neighborhood? And they'll tell you. And if you hear something interesting, that a big business is coming, that Amazon is opening a new Whole Foods, that Best Buy is doing something, that something is happening. I don't know why I said Best Buy, but something is happening here that's going to be driving new demand, that's going to be driving new businesses. That can create opportunity for you, because now you can capitalize on the increase in real estate value in the area by owning some of the real estate. And then when rent prices go up, well, now you get to reap some of the rewards of that. And finally, you have walkability. So if you're investing in cities, walkability is extremely important because people want to be places where they have easy access to buses, easy access to subways, easy access to public transit, and easy access to food and groceries and everything around them. So walkability is extremely important when you're investing in those types of city and urban areas. But this is where you got to understand what type of investor do you want to be, because you also have some investors that hate the idea of investing in big cities. I know some investors that I work with that do the complete opposite. They invest in more rural type areas, and what they say is that one, there's much less demand, they're not competing against other investors, and second, the tenants that live there stay longer because they just live in these rural areas for much longer and people don't really move. So it's a completely different game, completely different demographic, but it creates opportunity for, depending on what type of investor you want to be, it creates opportunity for you if you know what the goals are. If your goal is to be investing in the rural type areas, you really got to know the neighborhood. You really got to know the people, and you're not going to have the same type of demand as you would in this heart of Manhattan. And so you got to understand where do you want to be, and the returns that you're going to get are also going to be different. You have smaller returns in Manhattan, generally, if you're looking at a cash-on-cash investment, because, well, it's much more expensive to buy in Manhattan than in a village somewhere. But in that village, you're not going to have thousands of tenants and thousands of people that are willing to make applications to live in your place. So you're going to have higher vacancies, and you're going to have higher wait times. And if you have a turnover, that can be more costly. So you have to understand where it is that you want to be, or somewhere in the middle as a suburban investor. So there's many different types of investing, and each one is going to have their own goals and have their own interests, and tenants are going to want different things. If you're investing in cities, that's great. But you got to understand that what people want is walkability, and something that will help you understand this is going to walkscore.com, and you can see what the walkability is for a particular address and a particular neighborhood. That way you can see if that's somewhere where people would like to live. The last thing that I want to mention on location and walkability is you can also consider investing where walkability will be increasing. Like in Detroit, there was a new rail that was put in, and many investors started buying up land around where this new rail was going to go to start investing in this new walkability, because this new rail was going to create a new line of public transit, and that would open up more opportunity for people to go from one place to the other. And so people started buying up the real estate all around it in anticipation for the new rail. But you just got to make sure that it happens, because if that new rail isn't as good as what people would expect, then you might be buying up this real estate and then find out that it's not as valuable as you would like. So you got to be careful with that type of speculation because there are risks involved with it, but it can create opportunity if you see the walkability increase. The reason why location is first is because you can change everything about a property except its location, which is why location is so important. Now this brings me to number 2, which is understanding your team. And I'm going to be highlighting 8 different team members that you need to have if you're going to be investing in real estate. This is your property manager, your real estate broker, your accountant, your contractor, your attorney, your banker, your title company, and your insurance company. Let me start by talking about your property manager, because either your property manager is going to make your life completely miserable or they're going to make your life very free and clear. I have worked with a lot of property managers. Some of them are great, some of them are very, very bad. And the bad ones will make your life literally a nightmare. My first property manager that I ever had, I don't even know if they were a real licensed property manager or not, but my tenant had my phone number, and so my property manager did nothing. They were collecting the rent, they were collecting their fees, but my tenants would call me anytime something went wrong. Now, the whole purpose of a property manager is to make real estate passive for you. When you buy the property, you're supposed to give them the keys, and then they're going to manage everything. They're going to find the tenant, they're going to make sure the tenant pays, they're going to make sure the bills are paid, they're going to handle all disputes with the city, with the tenant, and everything in between, and then they're going to take a small fee. This fee might be somewhere between 4% to 10 or 11% of your gross rental income, depending on how many units you have, depending on how much work that they're going to do. Now, this is a cost to you, but it also saves you a whole bunch of time, because now the real estate whole investing process can be completely passive on your end, and your job is to be a real estate investor, not a real estate manager, which is why I never manage my own properties. But my first property manager was a property manager who was supposed to make it passive for me, but it was anything but passive. So I was getting calls from my tenant, I was dealing with all the issues, and eventually I fired this property manager, then I got another property manager. Now the second property manager was a lot better. They documented everything. I had a lawsuit happen in one of my real estate properties where a tenant sued my real estate company because they said that the bathtub got too slippery when the water was on, and it caused them to slip and fall because the bathtub was too slippery. Well, anyways, that case got thrown out because ultimately they figured it out that the tenant didn't slip in the bathtub. The tenant ended up slipping at a barbecue. They were just trying to go after some money, and they did get some money, but the tenants actually didn't get any money because my insurance company settled with them, and they didn't make enough money to even pay the attorney fees, so the tenants ended up getting nothing. But that's real estate, and that's the way the world works, especially here in America. We are the most litigious country in the world, so you have to be prepared for these types of things. Well, having a good property manager can definitely help with that, because one of the things a property manager is supposed to do is document everything. Every time your tenant has any sort of communication with the property manager or with the contractor, this needs to be documented. And if you are the one that's documenting everything, well, it's going to be a huge pain in the asset. This is why I don't recommend you doing that. This is where you want to have a good property manager to do that. Well, that same property manager company had some changes internally, and then they started not really managing properties. I had a property, and this is here in Michigan, where it gets cold. I had a property that didn't get winterized, because when it gets cold in the northern states, you have to winterize properties. That way pipes don't burst when tenants are not there and when the heat is not on. Well, this property was not winterized, and then a pipe burst because, well, nobody was there, and for some reason the heat didn't work. And now the pipe burst and the whole property got destroyed, and nobody knew about it. This property just kept flooding and flooding and flooding. And then eventually somebody from the property management team went out there to go show the property to get it leased out, and then they see that this property is completely flooded, and this created a huge mess. Well, that property management company then had to pay me a lot of money, and then I fired them. So this is where you have to make sure that you have a good property manager. Now, how do you find a good property manager? Well, you have to ask them a lot of questions. One, how are they getting paid? Some people say that it's very bad to pay a property manager a flat fee because now they're getting paid even if a property is vacant. I've had different experiences where it's not that big of a deal if a property manager charges you a flat fee, so long as they do a good job. I don't like when property managers are going to charge you a fee to then do any sort of construction work. What that means is a property manager is going to do all the repairs, or they're going to go find a contractor to do the repairs. You're going to have to pay for the repairs. That's the way it works. But then if the property manager is charging you a fee to then manage and issue the repairs, that I don't like. Because many times what I've seen happen in the past, with myself as well, is when a property manager is charging you a 10% fee on top of whatever the repair is, they're not going to have the best incentive to go out and get you multiple bids to find you the lowest price possible to do a renovation, to fix a deal, because the more that you have to pay, the more the property manager makes. So I don't like that. Second, when it comes to the way that they handle tenants, you need to understand what are their policies when it comes to issuing the eviction notices? What are their policies when it comes to being lenient on tenants? Because you want to make sure that whatever their policies are align with you, and you need to make sure how you get paid. When there's a late fee, who gets that money? Is it the property manager or is it you? I don't think it should be the property manager. I think it should be you. Maybe the property manager takes a little bit if they're going to be issuing notices for the late fee or because the tenant's late. But that's money that you should be receiving, not your property manager. So you want to be asking these questions and understand what their protocols are and know where you can find all the information about your properties, about your leases, and about your P&Ls, your profits and losses. That needs to be figured out early on. So ask these questions to your property manager. Second, when it comes to your broker, the biggest mistake that I see real estate investors making is they try to find a real estate agent who is well known, a good real estate agent, and then they want them to represent them to find them real estate deals. Well, a regular real estate agent is helping people buy and sell the home that they live in. They're not helping real estate investors find a real estate investment deal, because a real estate investment deal is very different than the home that you're going to be living in. And that real estate agent who's going to be sending you deals is going to show you deals that somebody would want to live in, but not something that you want to invest in. And these are completely different deals, because a cute home is going to give you cute profits. And you got to decide, do you want the cute profits or do you want the big profits? And it's going to be a completely different way of the way that you look at deals, the different way that you look at properties, different locations, different types of properties, because somebody who wants to live in a home might not want to buy a beat up property. But that beat up property can make you much bigger returns if you come in and renovate it, because you'll be able to buy that property for a huge discount, and then you can fix it up and then rent it for a better price, because now you have a fully renovated property and you got it at a discount. So you want to make sure you have a broker that specializes in real estate investment deals. And even if you are a real estate licensed salesperson like I am, I'm a licensed salesperson. I got licensed when I was 20. I used to work with people who wanted to buy and sell homes. I worked with investors. I worked with a bunch of people, but I don't broker my own deals. I have another broker that I work with. I go look at the properties. I'm licensed, so I can go and do that. But then when I want to do up the paperwork and do all that stuff, I call up my broker and I have them fill out the paperwork, and then they send it to me, and then I sign it and send it back to them. That way my work is less. I want it to be as passive as possible for me. So I have a broker that I work with that does all of my contracts, and that way now he takes a piece of his commission. I still get a little bit of commission, and I just put that into the deal because I am a broker. But this is where understanding what are your goals. Do you want to be doing all the work to find the research, to find the properties, or can you hire somebody to do that? And that's where a good broker can help. Then you need a good accountant. I cannot tell you how valuable a good accountant is, because I've had a bad accountant and I've had a good accountant. And if all your CPA is doing is filing your taxes, you are leaving a lot of money on the table. And if you are going to be investing in real estate, you absolutely need a good accountant now, because now it's not just showing your W-2. There are so many different deductions, so many different things that you can do in real estate to allow you to make money and pay less money in taxes legally. And your accountant has to understand and specialize in real estate investments, because there is so many different types of deductions, so many different legal loopholes that you can use with real estate that will allow you to pay less money in taxes legally. And you want to bring the accountant on and make them informed from the early stages. As soon as you buy the property, that's when you need the accountant to understand what's going on, because there's so many different things that you can do when it comes from buying the property to doing the depreciation to potentially doing accelerated depreciation to then potentially offsetting some of the income that you make outside of real estate through the real estate that you're buying. So talk to an accountant about the different strategies that you can use, where you use real estate to offset some of your other income, and where you use real estate to generate cash flow but pay less money in taxes legally. Fourth, you need a contractor. Again, I've learned this the hard way, because I've had good contractors and I've had very bad contractors. And very bad contractors will save you a lot of money right now. But if things go wrong, then not only are you going to have to pay to fix their work, but then you're going to have to pay to do the work right. And I have dealt with this on multiple occasions, because in the beginning when I was getting started, I found the cheapest of the cheap contractors, and they did work cheaply, Sometimes quickly, sometimes not so quickly, but it's such a pain where you have to stand over them every single day to make sure they're at your property, to make sure they start working, and then when they're not working, you got to call them to see where they are, because then they start another job in the middle of your job. Get a good contractor. It's going to cost you a little bit more, but it's going to save you so much headache. It's going to save you so much time, and it's going to save you money in the long run, because when you have to keep paying to fix up your previous contractor screw-ups, it really starts to add up. And then it makes tenants upset because things keep breaking because your contractor didn't fix it the right way. So now I work with a licensed and insured contractor. And yes, they charge me more money, but it costs me way less headache and my things get done correctly the first time. Pay more to do it right the first time, because if you don't, well, 5 years later, you're going to understand why it's way cheaper to have a good contract to do it right the first time. You all learn. Everybody learns at some point. Then you need a good insurance person, because guess what? As a landlord, you need a good insurance. You need landlord's insurance and you need liability insurance. I talked about the time that I got sued because a tenant claimed that the bathtub was too slippery when the water was on. And, well, I had to go through my insurance, because now you need an attorney, someone who's going to charge $300 to $500 an hour, who is going to sit there and defend you. Now, even though I was right, somebody still had to pay the attorney hours worth of work to go through the whole process to get this case settled and dismissed. And yes, we had to go through a settlement because it was stupid. The judge wouldn't see it. The judge said settle this outside of court, but you still needed an attorney to do that, and then the insurance company had to give the other party some money so they go away. The tenants who were suing me didn't make a penny, but we still had to go through this whole process because that's the way the system works. It's crazy, I know, but this is why you need insurance. So make sure you have landlord's insurance, make sure you have liability insurance, and it doesn't hurt to spend a little bit of extra money to up the insurance, because we live in a very litigious country. Then you need your title insurance. Now, title insurance has been known to be one of the biggest wastes of money when it comes to insurance. Well, it is a waste of money that you hope becomes wasted, because guess what? I've also dealt with title insurance issues. This is what happens when you go through a lot of real estate deals. Title insurance is something that protects what you buy. So if you buy a property, you think you're buying a home, what title insurance says is that you're actually buying the home that you think you're buying. In case somebody from 10 years before comes and says, no, I own this property. You bought it from somebody who didn't actually own it. Title insurance is there to protect you against those types of situations. They are very, very, very rare. But when they happen, that's when title insurance can be valuable. Now, title insurance is something you get typically when you just close on the property, but you want to make sure that you have title insurance, because there's sometimes when you go through auctions, you go through foreclosures, that you don't get this type of title insurance, but you want to make sure that you get this because it can save you a huge headache. I bought an apartment complex on a lake. And this apartment complex was made up of 4 different parcels of land. It was a beautiful area, beautiful complex. It was run down, but I was coming in to renovate it and turn it around, and I did. And a few years after I purchased this property, we fully turned the property around. We put in a ton of money into this property, and now it's fully rented, because when I bought it, it was completely vacant. Now this property is doing great, and it's producing a lot of positive cash flow. And then I get a letter from my attorney saying that apparently somebody else now owns a piece of my land. And I said, what are you talking about? So somebody had a claim on this land, and they had owned this claim to somebody else, a previous owner. And this never trickled down to me. And the title company never discovered this. So whoever owned this property and had this loan on the property wasn't making payments because they no longer owned the property. And then the bank, the lender that was owed money from the property, wasn't receiving money. So then they started issuing foreclosure notices. And where did they put these foreclosure notices? Somewhere on the property where nobody was going to see it. And so they put it on the property, and they knew that nobody was going to see it, because apparently that's the way the game works, because they wanted to get the property. They didn't want the money. And this went on and on and on. And then eventually they put up enough notices, and then they got the right to the property. So now we get a letter saying, hey, you no longer own this piece of the property that cuts through some of the units, that cuts through some of the land. And now they say that we own this and that we have to pay them for it. So what did I do? Well, I told my attorney talked to my title company, and then my title company had to then settle with that previous owner. Yes, it is very rare, but you don't want to have to deal with the headache if it does happen. Then you need a good banker. If you are financing your properties, you want to make sure you have a good banker that is going to be there to then help you get approved, to help you get the financing, and then who's not going to screw you over later on when things start to go wrong, because the reality is the economy goes through ups and downs. And so banking, while it might seem just like a transaction, you need to borrow money from somebody else, it is a very much a relationship thing. So you want to make sure you know the person that you're working with, that they know you, they know your business model, they know your goals. So keep that relationship with your banker, because they're going to be able to save you a whole bunch of headache later on. And just like anything else, you got to make sure you have a good attorney. Look, I am a licensed attorney, and I don't do any of my own legal work. I have a number of different real estate attorneys that I work with, people who specialize in different things, and you want to make sure you have an attorney from the early stages of the deal. Even if you're buying a single family home or a condo, get an attorney early on board so they know what you're doing, so they can give you advice. That way maybe it's creating an LLC. That way they can make sure you don't miss the insurance part. That way you know you have all the things in place before you buy the property, that way you're protected legally, and that way your contracts are reviewed. And sometimes you might say, but it's just a standard contract. Yeah, well, sometimes it's not. And you want to make sure that nothing is sneaking through the contract that shouldn't be, that they make sure that your title insurance is what it should be, that they make sure that your closing is giving you exactly what you should be getting. So make sure you have a good attorney. If you need a good attorney, I have a referral service where I can refer people to a good attorney. If you want to learn more about that, I got the link to how you can find a good attorney, not just real estate attorney, bankruptcy, a business attorney, whatever kind of attorney. If you're looking for a good attorney, I'll put the link to how you can be referred to a good attorney down in the description below. The third thing that you have to do is run the numbers to make sure the deal makes sense financially, and you're going to always start with this even if you're getting debt to buy the property. So you start with what you think the rent is going to be, then you subtract the property taxes, and if you're going to be buying this property, you have to calculate if property taxes are going to be going up, because if you're buying a single family home where somebody lived and now you're going to be renting it out, well, your taxes are going to go up, because most cities charge higher taxes to landlords than to homeowners. And if the property value, the assessed value, is going to be going up, well, your property taxes are also going to be going up. So you can talk to the assessor in the city, and they'll give you a better idea of what your property taxes will be after you buy that. So just talk to the assessor, see what the property taxes will be. Then talk to a couple insurance agents to get an idea of what your insurance will be. You need insurance. You subtract your property taxes, your insurance, your maintenance costs. Now, this maintenance cost is going to be a number that you're going to have to calculate. If the property is older, if it needs more maintenance, you want a bigger number here. If it's newer, well, you don't want to put zero, but something. A fraction of 1 month's worth of rent. So you could put a month's worth of rent or a fraction's worth of rent, depending on how new the property is and how much deferred maintenance is on the property. Then you're going to subtract your management fee. Even if you're managing the property yourself, which I don't recommend, you still want to pay yourself, because you have to make sure that you factor in your time, where if somebody else was going to do it, how much would they charge? So you got to make sure that the numbers make sense, even based off of yourself managing it. So if you are managing yourself, put in a number. If you have somebody else manage it, enter in what their number is, and then enter in a vacancy factor. Even if your property is fully leased out right now, eventually a tenant is going to leave, and you're going to have to then re-tenant that. And when they leave, there's going to be a period of time where nobody is in there, so you want to make sure you enter in a vacancy factor. I like to typically put in 1 month's worth of rent. It depends on the economy. Sometimes it might be 2 months or a month and a half, just depending on where you are in the economic cycle. But enter in a vacancy factor. So now you start with your rent, you remove these expenses. This is your NOI. If this NOI is big enough, well, that's a good deal. If this NOI is negative, that's not a good deal. Now, how do you know if an NOI is big enough? Well, what I like to look at is I take this NOI number, this monthly NOI, multiply it by 12. So now you have an annual NOI number. This is how much profit you expect to make. Again, if you're using debt, we'll talk about that in just a second. But this is how much profit you expect the property to make over the year. And then you divide that by the price of the property. And this will give you something called the cap rate, or the return on your property. And if that number is high enough, well, then that's a good deal for you. If it's not high enough, then you want to keep looking. And I'll show you what that means right now. Let's assume, for the purposes of this video, that you can buy this property right here for $100,000. And this property is going to rent out for, let's just say, $1,100 a month. And you have $500 a month worth of expenses. So you go through the same analysis that I just showed you, which leaves you with $600 a month of projected NOI, projected profit. Now, I'm going to take this $600 of monthly profit, multiply it by 12, which means that I'm going to have $7,200 of annual NOI, net operating income. That's what NOI stands for, or profit. Now, I'm going to take the $7,200 of annual profit, NOI, and I'm going to divide it by $100,000, which is the total price of the property, which gives me a 7.2% return. For me, that is a good deal. I look for anything more than 7% here as the initial rule of thumb when it comes to investing my money. If it's more than 7%, I will consider the deal. If it's under 7%, it's not a good enough return. Now, this return is going to depend from area to area. Some neighborhoods are much higher, some neighborhoods are much lower. You got to decide what is a good rate for where you are. But for me, I know that I want a 7% return. This is where now you have to do your debt analysis. Let me wipe this off and show you what that looks like. If in this case you were to put down 20%, that would be $20,000. So now you put down $20,000, that's your equity, and you're going to be borrowing the other $80,000. And if you borrow the other $80,000, that's a 7.5% interest. That means now your interest rate is going to be costing you $560 a month, which means you have a $40 a month profit now, which $40 a month times 12 is $480. So $480 is your new profit. Now, the way that you're going to calculate your return now is you take your $480 that you're making in profit, and you're going to divide that by your equity, which is $20,000. Here now, it's about a 2.5% return on your money when you factor in debt, which isn't a very good return because now that you're getting debt, you have a higher risk. Because your higher risk is you have to make payments to your bank. So you want to be compensated for that. So you want a higher return here than you would if you just paid cash. And this is where you got to start with the cash analysis. Then you do the debt analysis, and you want to make sure if everything makes sense. If the location is good, the numbers make sense, the next thing you want to move on to is the due diligence. This is after you enter into a contract to buy the property, where you now review everything to make sure that everything is good. As soon as you enter into contract to buy a property, there's going to be 5 people that you want to call. One of them is not listed here. This person is whoever's going to be helping you finance the property. Whether it's a bank, whether it's investors, you want to call them to make sure you can get the cash, but that's not really going to be your due diligence. The due diligence is going to be working with 4 people. One is your property inspector, one is your property contractor, one is your property manager, and 4th is the city. Let me start by talking about the inspector, because as soon as you enter into a contract to buy this property, you want to make sure that this property is what you think it is. And this is where you want to get a private property inspector who's going to be walking through the entire property to give you a report on the health of the property. You have to do this, because I can tell you from experience that if you don't do this, you can run into a ton of mistakes. My worst deal ever was a deal where I trusted my contractor, who was not a property inspector, that I should go out and buy a property. He told me to buy a property because, well, he said that we could flip it for a quick return, and turns out that he really just wanted me to write him a check so we'd have some work to do because he was struggling financially. I ended up buying a property that was so run down that you couldn't see because it was covered up with a whole bunch of problems, where the pipes were completely frozen because somebody had poured cement down the pipes, where nothing worked, the HVAC units were shot, everything was just wrong in the property, where it cost me tens of thousands of dollars, way more than what I expected, because I did not get a property inspector to walk through the property, to look at the pipes, to look into the basement, to look into the foundation, to look into the attic, to make sure that the property is what you think it is. So do yourself and do me a favor, pay a few $100s and get a good property inspector to walk through the property as soon as you enter into a contract to buy it, before you actually close on it. That way you know what you're getting. Second, get a good contractor to walk through the property, because if you're going to be doing renovations, you need to know what it's going to cost you. And the price of things have always been fluctuating. So this is where, as soon as you know what's wrong, you know what you need to make changes on. And if you're going to do renovations, get your contractor to walk through the property so you know an estimate of what it's going to cost you to make the repairs. And if it's way more than what you thought, then you can back out of the deal. But if it's in line with what you thought, well, now you already have your quote, and as soon as you close, you can get the work started. Third, get your property manager to walk through the property. That way they can get an idea of what the property is. They can give you renovation ideas if things need to be upgraded, because they should know the neighborhood, they should know the city, they should know what tenants want in the area, and they'll be able to give you a good idea of what you can get for the property in terms of rent, and then you can make sure that what you can get for the property is in line with what you expect. And 4th, Get the city involved because you want the city to know that you're looking at buying this property, that you want to rent it out, because maybe they're creating some new restrictions on new landlords. You got to know that before you enter buy the property. Maybe they have some outstanding liens. You want to know this before you buy the property. Talk to the city, see what needs to be done in terms of licensing, because if they have their own requirements in terms of licensing, if they have different changes that they want to make, you want to know that beforehand, because if you don't know that, it can end up costing you a fortune after you buy the property with a whole bunch of repairs and upgrades that you didn't know that you have to make. So talk to the city beforehand, before you close on the property, so you know what the total cost will be to turn the property around after you close the property. This is going to be done in the due diligence phase of the property. You always want to have a due diligence phase where you have time to do these types of inspections. If you don't do these inspections, you are taking on a huge risk. And the reason why I'm emphasizing this is because I made this mistake and it ended up biting me in the asset. So please don't make the same mistake that I did and get these inspections before you close on the property. And the fifth thing that you have to understand is, how do you increase the value of your property? And for me, what that means is, how do I increase the cash flow from the property? Because when I invest in real estate, my goal is not to flip the property for a big profit. My goal is to generate cash flow, because I want enough cash flow from my real estate to be able to live my life that will now have this passive cash flow that I can use, and I can live my life without having to worry about the cost, because every month I'm going to get another cash flow check from real estate. So the question is now, how do you invest in your properties to increase the cash flow? And this is going to require research on your end, and this is where a good property manager can help you. Just yesterday, I was talking to a property manager of mine, and we were talking about an apartment complex that I own. And I was asking him what his thoughts are on buying another property and what the different options were and what my goals are, because he knows that I'm looking for a 7% cash on cash return on my deals. And he said, one of the things that we could potentially do is do a $250,000 investment into this particular investment complex. And what he says is that we will be able to increase our NOI by 11%. If I make this $250,000 investment by upgrading the bathrooms, by upgrading the kitchens. Because according to him, he does the research. He's been looking at different properties. He manages different properties in the area. He sees that there's more upside in the area, but we need better units. We need better kitchens. We need better bathrooms. And so if we can make this investment to improve the property, it's going to cost me money today. I can use that $250,000 to go out and buy another property, but it's harder right now to find a good deal. But if I take that same money and invest it into my own property, I can increase my rents, I can increase my NOI, and I can create a better property for my tenants. There's an unlimited number of things that you can do to increase the value of the property, but what you should do is going to depend on your market, and that's going to depend on what people are already willing to pay for. Now, you can be one of the people that's the trendsetter, you can be the person that's creating the new value, but typically that's going to require either a lot of money, because now you're going to be making a brand new development that's creating a brand new type of market in the area, or you're going to have something small and you're going to hope for somebody who wants an exceptional property that no one else is willing to pay for. If you're in the middle, I rather look at what other people are charging and make sure that I'm in line. That way I'm not overcharging people, I'm charging within the market, but I know that I have one of the best properties in the market. So look around. Are people having upgraded bathrooms? If so, what's in their bathrooms? Do people have upgraded kitchens? If so, what's in their kitchens? Do they have stainless steel appliances? I love putting stainless steel appliances in my units, because most tenants, when they come from other properties, they have those ugly, old, dirty appliances. But people love stainless steel appliances, and it doesn't have to cost you that much more to get a nice stainless steel appliance in your unit. Tenants love it, they're willing to stay longer, and many times you'll be able to charge a little bit more. If you can charge an extra $25 a month for your upgraded appliances, well, you might make your money back in 3 or 4 years. Kitchens, bathrooms, floorings, and ceilings can help you deliver a lot more value in your property, but you want to make sure it's in line with what's happening in your area. So if you don't want to be the person that's walking through the different properties for lease in your area to see what's possible, then get a good property manager who's going to be doing this for you, that can create a proposal about what needs to be done to increase the value of your properties. And then just naturally, when you upgrade a property, if it's a multi-unit property and you're making more money, it's going to be worth more money. And if it's not a multi-unit property and you upgrade a property, well, now your property is also going to be worth more money because you upgraded the property. Everybody says that if you want to become more wealthy, you got to work to climb your way up the corporate ladder. But that is one of the worst ways to increase your wealth, and I'm going to show you why. Growing up in a traditional Indian house, good grades was very important, and I assumed that your grades were linearly correlated with the amount of money that you were going to make. Better grades, more wealth. I used to believe that if I got good grades, I'd be able to get a good job, which is true. So if I got better grades, I'd be able to get a better job. That's partially true. And if I got even better grades, I'd be able to make even more money. Now that's not so true. Let me give you an example to show you what I mean. We'll talk about the Coca-Cola company with 2021 numbers. In 2021, the average worker in Coca-Cola employee made somewhere between $30,000 to $180,000 a year. This is from the people working in the factories to the drivers, all the way up to people working in the headquarters, the people that are the financial people, the directors, and all of that. You made somewhere between $30,000 to $180,000 a year. Now, if you were to climb up the corporate ladder in this level, you could work your way up from $30,000 to $50,000, maybe $70,000. If you go to the headquarters, now you can work to $80,000, $100,000, $150,000, up to $180,000 a year. Now, if you want to make more than this, you could at Coca-Cola, but now you're going to have to move away from just being a worker to now being what I call a thinker. Thinkers are typically your C-level executives. These are not people who are working in the company, they're working on the company. And in 2021, the CEO of Coca-Cola made $24.8 million. His name is James Quincy. Now, yes, he had to go to work at Coca-Cola every single day to earn this money. He made a lot of money, but he's not working every single day to bottle up the Coca-Colas and do all that work. He's thinking of how do I grow the company, what direction to take the company, what ideas can we come up with, and how to lead the company. So he's working on the company, not in the company. The workers are working in the company. Now, the difference here is when James Quincy made this $24.8 million, that's not all cash that he got in his pocket. That was part cash and part equity, meaning some stock in the company. This is where climbing the corporate ladder ends. For 95 to 98% of people, climbing the corporate ladder is right here. Then you have another percent or so of people that do this, that make it up to the C-level executive, and you have very few of those people. But then, if you look outside of the corporate ladder, you have the wealth ladder. That same year in 2021, Warren Buffett, who is an owner of the Coca-Cola company, he owns a lot of the stock, he made over $700 million in dividends. This is cash that he got in his pocket, and he didn't have to go to work at Coca-Cola every single day. He got the $700-some million because he just owned the company and he got the profits from the company. Now, there's 2 points that make this even more interesting. The first point is, who do these people, the thinkers, have their duty towards? Because these thinkers, when they're working every single day, their duty is not to take care of their customers. Their duty is not to take care of their employees. Their duty is to take care of their owners. This is the way that our system works because the thinkers, the C-level executives, have a fiduciary duty to increase the share value of their corporation. AKA, the C-level executives have a duty to increase the stock price. Who does that benefit? It doesn't benefit the workers unless you're taking a piece of your paycheck and you're buying some stock in your company, or unless your company is giving you some stock in the company. But otherwise, the changing stock price doesn't affect you. It doesn't affect these people unless you get equity, but it does affect these people. The thinkers are working to increase the wealth of the owners. So now, what does this mean? The system benefits these people. The second reason why this is so important to understand is because of taxes. When you are a worker here, you are a W-2. You're getting a salary, and this means you are going to pay the highest tax rates because our tax code categorizes income in 3 ways. You have earned income or ordinary income. This is the money you make from your job. You have portfolio income and passive income. Both portfolio and passive income, which is investment income, come with lower tax rates and more tax deductions. So now, you as the W-2 in this case will be paying somewhere between 15% to 30% in taxes depending on what state you live in and depending on how much money you make. But for a rough idea, you're going to be paying 15 to 30% in taxes for federal and state taxes. If you're making big bucks because now you're the head honcho, you're making that CEO salary, well now guess what? You're going to be paying 39 to 52% of this income in taxes, because when you're the CEO, you're still an employee, you're still getting a big W-2 income, so you're going to pay high tax rates. But now as the owner, when you get this money in dividends, the top tax rate here is 20%. There are some exemptions where you might have to pay a few extra percent, but in general, the top tax rate for your investment income today is 20%. Meaning, not only can you earn more money, not only do you not have to go to work every single day in the headquarters, but you are working and doing something else, making more money potentially, and also paying less money in taxes. This is why you want to do more than just trying to climb the corporate ladder, but you want to also own a piece of the corporate ladder as well. Now, how do you own it? You can buy it or you can build it. If you want to buy it, this is how you can start being an investor. You can start doing this with as little as $100. If you are an investor, you want to stay up to date on what's happening in the financial markets. That's why I created Market Briefs as a completely free resource to keep you up to date on what's happening in the markets. It's an easy to read resource. You can read it in less than 5 minutes every morning. And every day, my team will give you a simple breakdown of what's happening in the financial markets. So if you haven't joined Market Briefs yet, I'll put the link to how you can join Market Briefs down in the description below. The other option, if you don't want to buy it, is you can build it. This means now building the company. Now, building something like Coca-Cola or any other company isn't easy. You have to be an operator, but this is where you have to understand that everybody in America, in this economic system, should be a business owner. However, that does not mean everybody should be a business operator or a person who is running a company. Now, what does that mean? Well, if most people are not running or operating companies, but everybody should be an owner, that means everybody can be an investor. Everybody can do this by buying it. That means now taking the money you make here, a piece of it, every time you get paid, and moving some of this money here. It's the system where now you want to own a piece of our system. And now when you do that, you're not just working to climb the corporate ladder, because that's what you're doing at your job. Your labor is you working to climb the corporate ladder. You're working at your company every single day to make more money. But now the question is, why are you trying to earn more money? If you're just earning more money to buy nicer things, you're doing it the wrong way. That's what the majority of people do. The majority of people make more money to buy more things. That is a guaranteed route to being broke. If you really want to become wealthy, you want to be working to make more money. That way, you can own more assets. That means you're working to earn more money here. That way, you can put more of that money here. When you put your money here, now you own the asset. Now you have the workers in the company that are working to increase your wealth. These people are working these people to make these people richer. Now, you're already this person. Now you need to take the money you're making here and put that money here. That way you can become wealthy yourself. The stock market has made becoming an owner here much more accessible, and now thanks to digital brokerages, you can start investing in stocks like this with as little as $100, even less sometimes. Now, if you don't want to invest in public companies, you can also look at investing in startup companies. It's the same concept, but it's riskier because, well, most companies will fail. Most startups fail. 9 out of 10 or 8 out of 10 startups fail. So you got to understand the risk versus reward. And then the third very common option to do this would be by investing your money in real estate, because when you invest your money in real estate, now you're building equity not in a company, but you're building equity in these rental properties. And now you get paid this, not with profits from the business, but with profits from the rental property. They're investing in a ticker symbol as opposed to a company. They think, wow, this stock is paying out a 10% annual dividend. Let me just throw all my money into the stock because I'm going to make 10% of it back every single year. But if you're getting a 10% annual dividend while the stock price is falling 20% a year, you are in a losing situation. But if you know what you're doing, you have the opportunity to